Welcome back to Chipstock Investor. Today we're going to be talking about Microchip. This company had quite the earnings report last week, and it was a little rough, a little patchy.
Yeah, it sure was. Not great. But before we get to that, let's address a quick question that we had. Specifically, this question was about Confluent. CFLT is the ticker symbol. And if small cloud software vendors like this would see any material impact from the acceleration in the big cloud computing platforms. Amazon AWS revenue accelerated to 14% in the December 2023 quarter, up from 12% the quarter prior. Microsoft Azure up 30% compared to 29% the quarter before that. Google Cloud or Alphabet, Google Cloud revenue 26% to close out 2023 compared to 22% in the September quarter. Not dramatic numbers for the big cloud infrastructure companies, but when you're talking about in aggregate across all three of these companies, approaching 200 billion in annual revenue, even the slightest uptick in revenue growth can have a dramatic impact on a very small vendor like Confluent, which is the cloud data in motion company. You think like live credit card transactions or maybe a factory automation monitoring system, something like that, something that needs real-time monitoring. This company does less than $1 billion in annual sales. Why hasn't the stock had a more dramatic uptick from this? Well, they're not profitable by any count. They're very small, but maybe just broadening the conversation around software, cloud software in general, we could see an uptick in results for these companies as they report their final quarters of 2023. But we'll update on that because it will be a company to company specific discussion based on their business model, how profitable they are or aren't, because all of those things are going to dictate how the market feels about them at the moment. So thanks for the question on Confluent and the cloud software companies. Stay tuned. But yes, we do think that there will be a positive impact as we head into calendar year 2024 for the small cloud software companies.
Let's now jump into our industrial chip maker, Microchip. So far in the semiconductor industry earnings season, it's been crazy. If you don't deal in AI, you're continuing to see that downturn. And we're going to talk about that with Microchip today. They are heavily stilted in the industrial and automotive industries, and that last domino is starting to fall from the pandemic era chip shortage.
Yeah, exactly. The chip shortage from the last few years, especially for automotive chips, the EV industry, electric vehicles, kind of the poster child for that. Lots of new chips needed for these things. But as we talked about with Qualcomm last week, lots of other technology trends in automotive. But now there's oversupply. So what was a chip shortage now flipping to there's too much semiconductor supply in the market, and that inventory needs to be worked down. This is exactly what happened starting the second half of 2022 for consumer electronics, PCs and laptops in particular. Chip shortage flipped to oversupply, and it was a rough year plus slog for those companies that play in that market, Intel, Qualcomm, et cetera.
And Microchip definitely sounded the alarm on things getting worse before they get better. We'll talk about the high level numbers and then deep dive into what their outlook is in the upcoming quarter. These are the numbers for Q3 fiscal 2024, which for Microchip is the October to December 2023 calendar year. Revenue was down 19% year over year to 1.77 billion. GAAP earnings per share, 77 cents, down 26% year over year. Free cash flow down 30%. You can see the theme here. A lot of things down significantly in this quarter.
It's getting ugly. The good news, we'll just hit a little high point here. They did return $350 million to shareholders via dividends and stock buybacks. They have that $4 billion total share repurchase program. And they are continuing to pay down debt, $281 billion in cash and short-term investments. That's up a bit from the start of the fiscal year last March. Debt down to $4 billion. compared to 5 billion. So the balance sheet after that big micro semi acquisition in 2018, it's getting healthier. But the downturn is here, Casey. And as you alluded to, things are going to get worse before they get better. That showed up in the outlook in kind of a nasty sort of way.
Before this, Microchip and many of the industrial peers had been saying that they expect the downturn to bottom this summer in 2024, calendar year 2024. But it was noted that Microchip pulled that guidance and isn't really providing any precision on exactly when they expect that downturn will end. Microchip's management tends to be on the conservative side, but it is definitely worth noting that they pulled that guidance. Q4 revenue at the midpoint is estimated to be 1.325 billion, which is down 41% year over year, and the GAAP earnings per share at 13 cents to 32 cents, which would be down 71% year over year at the midpoint.
Yeah, so the next two slides we just took from Microchip's earnings presentation. You can see here in the previous report for their fiscal Q2, which ended in September, they still have that 10 to 15% growth outlook on average. This quarter, they've removed that. And about that, CEO Ganesh Moorthy said that a lot of their industrial customers have been asking to cancel orders, including non-cancelable backlog. As it turns out, non-cancelable is in fact cancelable if things get really bad. But a little perspective, Microchip expects full year revenue to only be down 9.5%. Remember the first half of this fiscal year, they were still putting up some impressive growth numbers. One more slide here from this presentation just to show what's going on, because this is important. Even with things looking worse and worse in the March quarter and through the first half of this calendar year, 2024, little historical perspective, Microchip has this history of maintaining profitability even in down cycles. And they're taking some aggressive steps, putting employees on furlough, reducing their manufacturing activities, cutting costs wherever they prudently can to make sure that those profit margins don't dip into the red. So that's a bit of upshot here for Microchip.
Another bright spot for Microchip, the board also announced that they increased the dividend 25.7% from a year ago to 45 cents per share. They repurchased 114.6 million of stock and paid out 237.4 million in dividends. The total cash return ended up at 352 million.
So the big question now at this point, Casey, is how bad are things going to get before they start to improve? It's clear at this point, Microchip is going to aggressively undership new chips to what's being actually consumed on the market to get rid of all this excess inventory as quickly as possible. And CEO Moorthy on the earnings call made a very simple statement at one point. They're expecting that they will drain inventory in the distribution channels in the March quarter. So that's the distribution channels versus Microchip's direct relationships with customers, which is approaching 60% of sales. At any rate, later on, he elaborated that this is not a typical downturn. This is on the order of magnitude to what happened in the 2008 to 2009 financial crisis. So this is shaping up to be an industrial and automotive chip downturn, worse than the pandemic, because that was a pretty brief flip from, no one's buying cars, no one's buying industrial equipment, to very quickly these industrial customers saying, give us everything that you have on hand right now, ASAP. So this is going to be a bit worse. But again, maybe just a little perspective, this does tie in with what happened in the consumer electronics market, which often cited as the worst downturn for consumer electronic chips since, if not 08, 09, at least maybe the dot-com bubble. So this is going to be a nasty one. Maybe it takes a bit more than summer 2024 to fully work things out.
One other thing that we want to talk about, and is definitely a vital point that we need to talk about in regards to Microchip and other manufacturing companies like it, is the market in China. But before we get into that, just a quick reminder that we are going to be publishing our show notes for each of these videos that we do, which has more in-depth insights, more selected comments from the earnings calls and our takes published in a PDF, either on Ko-fi a la carte, or you can join our membership here on YouTube or on our Ko-fi page. You'll get access to those with the membership in our Discord channel. But Nick, let's talk about that concern about China's manufacturing capacity.
Yeah, again, past videos, we've talked about this, especially with the semiconductor fab equipment providers, everyone from ASML to Applied Materials to some of the smaller players, like some of the metrology makers, shipped a ton of equipment to China all the way up until the end of 2023. And there's interest for China to ramp up its domestic chip making capabilities, just like everybody else in the world is interested in onshoring manufacturing, or at least in this case, keeping some onshore manufacturing, because a lot of investments are being made in moving that manufacturing outside of China, especially if this is like a US based company providing chips for US based customers. I think maybe we'll say this. At this point, it doesn't look like China's ramping up of production is having an impact on Microchip specifically. One reason I think we can say that is they picked up a lot of market share in microcontrollers, or MCUs. This is a combination of a simple processor with some memory, inputs and outputs, and then embedded software. That's why the memory is in there in combination with the simple processor to control all sorts of applications and processes. For example, maybe the way industrial equipment functions. So a lot of market share, and Microchip is focused on that total system design, combining not just the microcontroller design, but also software development as well. Not exactly an easy position to just simply dislodge by saying, hey, we make microcontrollers too, and they're a bit cheaper, because a customer might say, okay, great, but do you have the software development as well? If the answer is no, Microchip keeps its incumbent position. But it is definitely worth keeping an eye on here, because we're having this period of excess supply hitting the market at the same time as big new chip production companies in China are also ramping up their output as well. It could make things worse. It could aggravate things a bit. This could be more like maybe the memory chip market in 2022 and 2023. There was a market share battle going on between the South Korean companies, Samsung and SK Hynix and Micron and so on. Samsung in particular, not budging from its production output, even during the downturn, just trying to preserve its market share. And that kind of aggravated the memory chip market the last year and a half. Maybe something like that crops up here. It's worth keeping an eye on. We think Microchip is going to be okay, but as things have deteriorated very quickly in the last quarter, of course, it could deteriorate further without warning. So we'll keep an eye on this.
Let's talk about Microchip's stock valuation. We don't know at this point how bad things are going to get, but where do you feel like the stock valuation is right now, Nick?
Based on full fiscal year 2024 expectations, including the quarter outlook that we just provided earlier, it trades for about 25 times GAAP earnings or 17 times adjusted earnings, which will roughly align with free cash flow. Not perfectly, but roughly. So this is probably why the stock didn't get hit harder after earnings. It's not exactly grossly overpriced, even when you factor for the next couple of quarters, a continuous downturn, with this caveat, with the caveat being that Microchip does start to recover sometime during the second half of this year and gets back to growth and best-in-class profit margins. That's the assumption at this point. The market seems to be betting that this is going to be a temporary situation for Microchip.
I think our ultimate take on this is that we're going to continue to add to our position during the downturn on the assumption that this too shall pass. We have faith in this company. We like it. We like management. It's come back from every other downturn, and it's been a very solid company through all of these cycles. Industrial automation, vehicle tech, and embedded intelligent on device, such as AI, are still secular growth trends. And we like Microchip's mix of 40% internal fabs, 60% external partner manufacturing, and their in house software development.
Let's wrap it up, Casey. Again, our show notes with some extras from the earnings call and our take on this company, you can find on the Ko-fi shop or on the Discord channel, like Casey mentioned. And in just a few more hours, we're going to hear from On Semiconductor and our other industrial and automotive chip stock pick for at least the first quarter of 2024. But we'll see if we want to keep it as such, as one of our favorite picks for the start of 2024. So stay tuned. That video should come on Tuesday.
All right, sounds like a plan. Make sure you have hit that subscribe button and notifications are enabled. Don't miss a video, especially as earnings season rolls on. See you all soon at Chipstock Investor.